For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by John Nelson, financial advisor at NelsonCorp Wealth Management. Welcome back, John.
Thanks for having me, Brandy.
So the market had a pretty negative reaction to the latest rate hike from the Federal Reserve last week. Do you think investors were surprised at the move?
I don't think they were surprised. It was a rough week. The market lost about 5%. I think the 75 basis points was pretty much the consensus overall, but the future expectations that the Fed has laid out, I think, was the surprise. And the graphic I have with me today is referenced as the dot plot from the Federal Reserve, and this is just illustrating each Fed voting member of the Federal Open Market Committee, their outlook moving forward. So we've got 2022, 23, 24, and 25, and then a longer term view. And as we can see there for this year, in 2022, the expectation by year end is for the Fed to land somewhere between 4.25% and 4.5%. Now, that's a percent to 1.25% above where we are today, indicating that we will likely see another couple of rate hikes yet this year.
Okay, so what should viewers expect going forward if these forecasts by the Federal Reserve Board members are accurate?
Yeah, I'd say potentially more downward pressure in the market. Things like long duration bonds, utilities when it comes to stocks, parts of the real estate market are going to be under continued pressure. But at the same time, there are going to be other sectors like savings accounts, CDs, short duration bonds that are actually going to start earning some interest versus the last 8 to 10 years where the returns on those asset classes have been next to nothing.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.